Hey everyone, welcome back to Corporate Decoder, the place where we unravel the mysteries of corporate finance with a smirk and a wink. And today we have a report that is a bit of a roller coaster, showing how a fund navigates market ups and downs, and sometimes even a little bit of chaos. We're diving into a filing from the Equable Shares Hedged Equity ETF, or HEDG as it is known on the stock market. This report, covering the year ending the 31st of October 2025, gives us a peek behind the curtain of how this fund performed, what it invested in, and the behind-the-scenes moves that shaped its year. Think of it as a financial diary, complete with stock picks, market commentary, and all the nitty-gritty details that make or break an investment fund. And before we jump too deep, if you love getting these kinds of clear, no-nonsense breakdowns of financial documents, make sure you hit that subscribe button and join our growing community. We also have a fantastic Discord channel linked in the description below where we dissect these reports in real time, so do check that out. So what is the story here? This report is essentially a shareholder's guide to the Equable Shares Hedged Equity ETF's recent performance. It tells you how well the fund did, what it cost you to invest, and what was going on in the market that influenced its returns. Let's start with the cost. For a hypothetical $10,000 investment, the total costs for the year came in at a mere $113. That is about 1.09% of your investment. Now, in the grand scheme of things, that is not a huge number, especially when you consider the complexity of what this fund does. It is like paying a small convenience fee for someone to manage your money in a potentially volatile market. Now for the juicy part, the performance for the fiscal year ending the 31st of October 2025, the Equable Shares Hedged Equity ETF returned 9.41%. That sounds pretty good, right? But hold on, because the S&P 500 index, which is a major benchmark for the US stock market, shot up by 21.45% during the same period. So, while the fund made money, it lagged significantly behind the broader market. The report explains this by saying that their performance before the 13th of October 2025 was actually from a predecessor mutual fund called ECEX, which then converted into the ETF. The fund strategy involves holding stocks that track the S&P 500 index through an ETF called SPDR S&P 500 ETF Trust, or SPY, while simultaneously selling call options to limit potential upside gains, but also to generate income and manage risk. They also use a put option spread to provide an extra layer of protection against market drops. The report breaks down the year into two halves, showing how different market conditions affected their strategy. In the first 6 months, from November to April, the S&P 500 actually dipped slightly by 1.74%, while the fund managed a small gain of 0.74%. This is where their hedging strategy shines. It helps to cushion the blow when the market goes down. But then came the second half, May to October. This was a strong period for the stock market, with the S&P 500 surging by 23.60%. In this booming environment, the fund returned 8.61%. This is where you see the cap on their strategy. They limited their participation in the strong market gains because they were selling call options. While they protected against losses, they also sacrificed some of the big wins the market offered. The report summarizes this by saying the fund performed as expected, delivering capped upside in rising markets and mitigating losses in falling markets. Looking at the cumulative performance, a hypothetical $100,000 investment shows a clearer picture. In the 1-year return, we see that 9.41% again for the ETF. But over 5 years, it has averaged 9.01%, and since its inception on May 31st, 2019, it has averaged 8.05%. Compare that to the S&P 500 TR, or total return, which has averaged 17.64% over 5 years and 17.06% since inception. This highlights a consistent pattern. The Equable Shares Hedged Equity ETF aims for stability and risk mitigation, which often means sacrificing some of the high returns you could get by just buying the market. Now, let's peek at some key statistics. As of the 31st of October 2025, the fund's net assets, which is the total value of everything it holds minus its liabilities, stands at a substantial $305,504,442. That is a lot of money being managed. Interestingly, despite managing all that money, the fund only has 9 holdings. This suggests a highly concentrated portfolio, which can be risky but also indicates a strong conviction in their chosen investments. The net advisory fee for managing these assets was just under $1.9 million. This fee is paid to the investment advisor, Teramo Advisors LLC. for their expertise and management services. The portfolio turnover rate is 42%. This means that about 42% of the fund's holdings were bought and sold during the year. A moderate turnover rate usually indicates a strategy that is not excessively trading, but is definitely active in managing its portfolio. So what exactly were they investing in? Well, over half of their net assets, 58.3%, were invested in the SPDR S&P 500 ETF Trust, or SPY. This confirms their strategy of tracking the S&P 500. They also had a significant chunk, 39%, in the iShares Core S&P 500 ETF. Together, these two holdings make up almost 97.3% of the fund's assets. This is a very focused approach, heavily reliant on the performance of the S&P 500. This focus is even clearer when you look at security types. A whopping 97.9% of their assets are in exchange-traded funds, or ETFs. This makes sense given their core strategy of using ETFs to gain exposure to the S&P 500. Then you see purchased options at 0.3%, short-term investments at 0.1%, and then a chunk for written options at a negative 4.7%. This negative percentage for written options is interesting. It signifies the value of the options sold by the fund, and in accounting terms can appear as a liability or a reduction in asset value under certain circumstances, which is a key part of their hedging strategy. The report also mentions important changes like updating their principal risks to reflect ETF-specific risks. This is a crucial step as the fund transitioned from a mutual fund to an ETF. Another key event was the conversion to an ETF on the 13th of October 2025. With this change, they implemented a unitary fee of 0.88%. This unified fee likely streamlines expenses, covering various operational costs under one umbrella, a common feature in ETFs. And as we already touched on, the fund officially changed its name from the Equable Shares Hedged Equity Fund, or ECEX, to the Equable Shares Hedged Equity ETF, HEDG, on that same date. This marks a significant structural change. Prior to becoming an ETF, something else noteworthy happened on the 16th of September 2025. A reverse stock split occurred. This is where a company reduces the number of outstanding shares by consolidating them. For shareholders, it means you own fewer shares, but each share is worth more, ideally keeping your total investment value the same. In this case, they did a 1-for-2 split, meaning for every 2 shares you owned, you now have 1. This is often done to increase the share price, making it appear more substantial or to meet certain listing requirements. Diving into the nitty-gritty of their investments, the schedule of investments confirms their heavy reliance on ETFs tracking the S&P 500. We see the SPDR S&P 500 ETF Trust valued at over $178 million and the iShares Core S&P 500 ETF at over $119 million. These two alone represent the vast majority of the fund's reported assets. They also hold purchase put options, expiring in December 2025, for a notional amount of over $92 million. These put options act as insurance, providing a floor against losses if the S&P 500 ETF drive ops significantly. On the flip side, under their written option schedule, they have written call options. For example, call options on the iShares Core S&P 500 ETF with an exercise price of $670 and on the SPDR S&P 500 ETF Trust with an exercise price of $660. These written call options contributed significantly to their liabilities, showing a value of over $4.9 million and over $9 million respectively. This is the other side of their hedging strategy. They sell the right for someone else to buy their holdings at a certain price, which limits their upside but often generates income premiums received. The statement of operations paints a picture of the fund's profitability. Investment income, mostly from dividends and interest, came in at a healthy $3.7 million. However, the expenses, particularly the investment advisory fee at nearly $1.9 million, eat into those gains. The fund realized a gain of over $6.2 million from investments, but this was overshadowed by a realized loss of over $10.7 million from written option contracts that expired or were closed. This highlights the cost of their hedging strategy when options don't play out as planned. The big story here is the unrealized gains. Investments saw an appreciation of over $36.7 million, largely due to the market's rise in the latter half of the year. However, there was a depreciation of over $3.5 million on their written option contracts, meaning the value of those liabilities increased. All in all, the fund saw a net increase in net assets from operations of over $23.4 million. This is the bottom line of their financial performance for the year before considering capital share transactions. Looking at the statements of changes in net assets, we see the fund's net assets grew by over $79 million during the year. This increase came from operations minus distributions to shareholders, and a significant injection from capital share transactions where they saw over $65 million in net increases from subscriptions and reinvestments. The financial highlights per S-Share offer a more granular view. For the year ending the 31st of October 2025, the net asset value per S-Share grew by 9.41% as we saw earlier. However, looking at the reported expenses to average net assets before any waivers or recoupments, it was 1.09%. After waivers, it remained 1.09%, indicating that the advisor did not need to waive significant fees this year. The notes to the financial statements are where we find the really detailed explanations. Section 2 talks about investment valuation. They primarily use quoted prices in active markets for identical assets, which falls into level 1 of the fair value hierarchy. This means their reported values are based on readily available market prices for most of their holdings, which is good for transparency. Section 2C explains their written option contracts. They use these for hedging, volatility management, or to gain or reduce exposure. When they write an option, they receive a premium which is recorded as an asset and a liability. This is a core part of their strategy to manage risk. This section is crucial for understanding potential conflicts of interest. It details the agreement with their investment advisor, Teramo Advisors LLC. Before the ETF conversion, the advisor had a tiered fee structure based on assets under management. After the conversion to an ETF, they moved to a unified fee of 0.88%. This change means Teramo is now responsible for paying many of the fund's operational expenses like administration, transfer agency, and custody fees. This is often a smart move for ETFs, as it can lead to lower net expense ratios for investors. The report also mentions that the advisor agreed to pay for some reorganization costs which they do not plan to recoup. Finally, the report from their independent auditor, Cohen & Company Limited, gives us their stamp of approval. They state that in their opinion, the financial statements present fairly, in all material respects, the financial position of the fund. This independent verification is a key sign of legitimacy and accuracy. So, what is the takeaway from all this? The Equable Shares Hedged Equity ETF, HEDG, is a fund with a clear strategy. It aims to provide market participation with a strong emphasis on risk mitigation. It does this by heavily investing in ETFs that track the S&P 500, while simultaneously using options to cap potential gains and protect against significant losses. This strategy means it will likely underperform in strong bull markets, as seen this past year, but it should offer more stability when the market turns south. The transition to an ETF structure with a unified fee is a positive move, potentially leading to more efficient operations and lower costs for investors in the long run. The fact that they hold very few distinct positions, with the vast majority weighted towards S&P 500 tracking ETFs, shows a high conviction in this core strategy. However, this concentration also means the fund's performance is almost entirely tied to the overall direction of the S&P 500, with the hedging strategy acting more as a dampener than a true differentiator in most market conditions. The reverse stock split and the conversion to an ETF are significant operational events that indicate the fund is evolving and likely aiming for greater market appeal and efficiency. Alright, that is our deep dive into the Equable Shares Hedged Equity ETFs report. What is your take on this fund strategy and its performance? Does the risk mitigation appeal to you, or do you prefer the higher potential returns of a less hedged approach? Drop your thoughts in the comments below. If you found this breakdown valuable, please give this video a thumbs up as it really helps the channel. And of course, subscribe for more corporate explorations. Don't forget to join our Discord community, linked in the description, for more real-time discussions and analysis. Thanks for watching, and we'll see you in the next episode of Corporate Decoder.